The year 2022 hasn't got off to a fantastic start. In general, stock prices have fallen, particularly in the United States. We would not really say there has been a stock market crash yet, but it might strike at any time. Now, what is a stock market crash? A stock market crash happens when stock prices plummet suddenly and without warning. A stock market crash can come about as a result of a significant tragedy or an economic crisis. Public hysteria in response to a stock market meltdown can also be a big influence, causing panic selling and further depressing prices. Among the most well-known stock market collapses in the U.S. are the market crash of 1929, which triggered the Great Depression as a combination of economic downturn and panic selling, and Black Monday in 1987, which was partly triggered by investor fear. Another dramatic crash in the housing and real estate markets happened in 2008, resulting in what is now known as the Great Recession. However, some experts believe that technically there is no such thing as a market crash. Instead, there are market corrections, or to put it another way, bear markets. Whenever the market goes down 20%, it is nicknamed a bear market, after the downwards way a bear fights. Number 1. Why do we bother now? Due to the outbreak of the COVID-19 pandemic in March 2020, financial markets throughout the world entered the bear market zone. Until lately, financial markets seem to have placed COVID in the rear-view mirror. At the barest minimum, the virus is expected to keep putting sand in the global economy's gears in 2022, slowing rebound and causing supply chain kinks. Investors pushed money into firms that benefited primarily from prior waves, such as Zoom communications for meetings and Peloton for at-home workout equipment, frightened of future lockdowns and travel bans. Over the last few months, the stock market has rocketed upwards, recovering rapidly from the coronavirus bear market and earning incredible profits. On confidence from their investors regarding the future path of their fundamental businesses, several companies have seen their stock prices double, triple, or increase even further. However, anytime the market rises rapidly, some investors get concerned about the possibility of a stock market crash. Some of those investors rely on particular sorts of equities that are perceived as less unstable than the broader market to safeguard themselves. Number 2, why is the stock market behaving in this manner? The pricing of a stock is affected by a variety of elements, ranging from investor mood to local and global factors like interest rates and supply chain concerns. However, there really are two hugely important participants in this scenario. The first one is the U.S. Federal Reserve, more colloquially known as the Fed, or not, depending on how your portfolio is doing. The Federal Reserve said that it intends to raise interest rates this year. This caused some concern, but as it was accounted for, the market cooled down. The objective of raising interest rates is to combat rising prices. The Federal Reserve is in charge of monetary policy in the United States. It is increasingly shifting from market-supportive asset purchases after assisting Americans during the pandemic. This didn't come as a major surprise at first. The immediate spike was similar to having the need to sneeze, but not really sneezing. A false alarm. The Fed next signaled that rates may be raised 3 or possibly 4 times. It was like one of those sneezes that sends shivers through the room, sending investors into a frenzy. Higher interest rates are frequently associated with worse firm revenue and stock market performance. Investors were ready to sell their more risky shares, wreaking havoc on the tech industry. ARK's innovative ETF, which is mainly composed of more volatile tech stocks and lost more than half of its value in the previous 52 weeks, is an example of this. Yikes. The second reason for the recent swings is related to the ongoing earnings season. That is when major corporations such as Apple and Microsoft release their previous quarter's financial results. It's similar to businesses publishing their report cards. Investors evaluate if these are enterprises they still wish to support, and if so, acquire or sell them. It becomes a bit of an extra chaotic moment in the stock market, but tensions are flowing much heavier now that the Fed is involved. Netflix released one of the most important earnings reports last month. It announced that it exceeded all expectations in the most recent quarter. Isn't that reason enough to celebrate? Netflix discussed its plans for the future and finally addressed the enormous competition it faces from alternative streaming platforms such as Disney+. It really was a big event, as Netflix's shares dropped 20% in only 24 hours. Investors will invest relying on their expectations for the future, not just their current opinions. Number 3, what exactly is the Fed doing to avoid a market collapse? For generations, the markets have been inflated by pretty comfortable monetary circumstances, with super-duper interest rates, and central banks printing money in the form of quantitative easing. However, the so-called Fed put is another reason that has pushed investors to pour more money into the markets. The assumption is that the U.S. Federal Reserve, as well as other central banks, would not tolerate markets collapsing below a particular point before intervening with lower rates and increased money printing. The debt in the international economic market has become so huge, the thinking runs that the markets can't go even a little lower. A larger decrease might trigger a snowball effect of bad borrowings, crippling the major banks and causing a catastrophe that dwarfs 2008's. Now, what is the Fed put? The concept, referred to as a put, in allusion to a financial instrument that market participants buy to safeguard themselves against a market decline, is that markets are basically a one-way bet. Number 4. The Fed put in action. When Alan Greenspan became chairman of the Federal Reserve, he came up with the notion of the Fed put. Beginning with the Black Monday stock market meltdown in October 1987, Greenspan became recognized for lowering the federal funds interest to boost investor enthusiasm when markets fell sharply. This was a significant departure from the Fed's traditional hesitant and painfully slow response to developments in the business climate. Greenspan's strong money creation following the dot-com catastrophe in the early 2000s aided in the inflation of the U.S. credit estate market meltdown, which triggered the 2007 to 2009 financial crisis. During that crisis, the Fed responded by cutting rates and increasing the amount of money in circulation through monetary stimulus. This excess cash pushed financial institutions to lend to firms and individuals in order to help the economy recover, as well as to market participants in order to invest it in the markets. When the global economy collapsed in the teeth of the COVID pandemic in March 2020, the Fed moved into full rescue mode. To stimulate the economy, it started the most extensive money printing program in history. All of this easing has resulted in a massive increase in asset prices, including stocks, bonds, and real estate. Though it is impossible to measure the impact, the richest 10% of Americans today hold over 60% of the country's assets, while the poorest 50% possess less than 6%. Number 5. Is the labor market in the game? Financial markets have been falling recently, despite the fact that the U.S. economy is doing well. In spite of the pandemic, it climbed by over 6% in 2021. The employment market is booming, and relatively low-skilled employees are able to obtain new jobs with greater pay. Consumer confidence, on the other hand, is low, owing in part to rising prices. Consumer prices in the U.S. increased by 7.5% in the year ending January 2022, the highest level since the early 1980s, and the scenario has indeed been identical abroad, especially in the United Kingdom. The main concern is that employees will desire equal pay raises as a result. This might lead to a wage price cycle, in which businesses increase their prices to compensate for greater salaries, which then in turn leads to even further salary claims, so on and so forth, essentially putting price level a longer-term issue. Well, the stock market is bound to fall at some point, but this isn't something that should keep you up at night. This is why. Number 6. Is it a good idea for us to sell our stocks? The fact seems to be that the stock market is really not acting in a way that we haven't seen before. Volatility is the term used to describe the stock market's frequent ups and downs. Every 16 months, there is a readjustment, so we're virtually on time. Indeed, there are just so many adjustments that we have records to accurately measure them. Stock market adjustments take as long an average of 71.6 days, and prices come down by 15% on average. There seems to be signs of increased market volatility, but there is really no evidence that we are on the edge of another financial meltdown like the one we saw during the Great Recession. Even when there has been a market meltdown, such as during the Great Recession, the markets have just always rebounded. Those who dump their investments whenever they panic are really the only genuine losers in a market drop. Those who panic sell their investments are the only true losers in a market drop. There's no need to panic if you're investing for the long run in a diversified portfolio that reflects your tolerance for risk and objectives. This is just another week in the market for us. So our advice to you is to stay assured that you will not lose money just by owning stocks during a market crash. It's when we sell stocks while they're down that we do financial harm to ourselves. So, what is the real fix? When stock prices fall, don't jump to any conclusions. That is indeed all there is to it. We will not be badly affected if we leave our portfolio alone for a while and wait for things to unfold. Otherwise, we'll just be staring at a loss on paper, or, these days, on screen. What else would you like us to talk about in our upcoming videos? Let us know in the comments below. And make sure to subscribe and turn on notifications so you don't miss out on any of our videos.